Hey guys, hope you're having an amazing Friday. Today's video is going to be a pretty quick one, I guess. Some people wanted to see what Gary Gensler had to say himself about hedge funds suing the SEC, and I think this is a lot better than just me talking about it, so here it is. Also, there's another interview with Gary talking about fails to deliver. He talks about market reforms and what the SEC is trying to do to bring more transparency. Before I post that interview, I do want to note that FINRA has also been adding a lot more regulations about the same topic. I wanted to go over this quick document that I came across. I'm just going to summarize it real quick.
I just also have to talk to you, Chair Gensler, about some of the legal challenges. Just this week, a group of hedge funds sued on the short selling disclosure rules that you proposed. There have been numerous other legal challenges to some of yours, the buybacks ones, the private fund industries. Do all the legal challenges undermine what you're trying to do?
Look, we do what we do based on the law and how the courts interpret it, and it's part of our great democracy. These industry trade groups or others have a right to go into court, but I'm very confident about the work that we've done. And let me just address a couple of the things you said. Transparency helps our capital markets. Transparency, economists have studied, lowers the cost of capital formation on the one side and raises the returns for investors because it drives to greater competition and efficiency in the middle of the market.
Well, they say though it discourages short selling and shames them, and it's an important part of the market structure.
I would say Congress weighed in after the financial crisis and mandated that the SEC address and have rules around the transparency around short selling for investment managers, I think is the term. And I got to the agency 9 years later. The SEC had not done a congressional mandate. I'm very proud that we took it up. We proposed something based upon a lot of public feedback, and we adopted a rule. And I think that it's really important. I mean, for many of those investors out there, the everyday investors that might be investing and looking at these markets, remember the events around GameStop. What was that? Nearly 3 years ago. And no, seriously, about transparency in the short selling market. We have a lot of transparency on the long side. Let's add the transparency on the short side that Congress mandated.
I only chuckle because of the list of issues you've had to tackle, from crypto to China to SPACs to memes to AI. I can't imagine it's anything like what you thought when you took the job.
Look, this is a great privilege. I pinch myself. I can't believe that this boy from Baltimore, neither of my parents went to college, has this opportunity, and I'm serving my third president. But more specifically, the great honor of being part of the 5,000 people at the SEC, and that we help oversee the markets and help those issuers and investors. But you're right, it's a wide swath of parts of the market, and the base of that market is the U.S. Treasury market. I'm just bringing it back because I'm so proud of what we did yesterday, and there's a lot of leverage in that market, and there's a lot of risk from time to time, and we want to promote greater efficiency and competition, but also resiliency in that market. We've got some really important projects around driving greater efficiency and competition in the stock market that you follow, the equity markets, and as like.
Well, there's been pushback on those proposals too. So can we expect another 24 or so rules in 2024?
I don't want to prejudge anything, Sarah, but you're right about the figures. We've now, I think, adopted about 30 proposed rules have now been adopted, again, from China to the Treasury markets to the transparency projects we talked about. But there are really important projects, and you're right, it's about 25 or so, that we are still considering the public comments, and we're taking them on only when the staff is ready, the commission's ready, and it's based on the economics and the law.
Well, we look forward to talking to you about each and every one of them, hopefully. Chair Gensler, thank you very much for taking the time.
Thank you so much, Sarah and Carl, and happy holidays to all your viewers.
Happy holidays to you.
First was regulatory obligations. Member firms are forced to have adequate controls and procedures to prevent and resolve short positions or fails to receive in municipal securities. The second one was related considerations. Firms should ask themselves to assess their compliance with relevant rules, such as how they monitor, close out, and communicate with customers in their municipal securities transactions. And third was finding and effective practices. This page pretty much reported some common findings for non-compliance, such as adequate supervisory controls and procedures, inappropriate use of lottery systems, and failure to follow the prescribed closeout timing. So I'm gonna leave a link to this whole document. You guys can go over it if you want. Outside of that, I'm just gonna post the second clip, which is a lot more interesting. Shout out to Superstonk for making this available to us.
Reg shows set out to reduce FTDs and limit how long an FTD can persist. But there are loopholes, and people are concerned that these loopholes are being exploited. Why are FTDs allowed in modern electronic markets? And what do you think is causing millions of FTDs per day?
Doing a number of things to lessen that, to lower that. Even this rule that we finalized a week or two ago about shortening the settlement cycle from 2 days to 1 day. We added something else. We said on the same day that a trade happens, the very same day, that you have to what's called affirm, confirm, and even allocate the transactions electronically that day as soon as technologically practical. We did something in addition that didn't get much press about what's called straight-through processing, so that all the electronic pipes connect.
Do you think that these loopholes are being purposefully exploited?
The actual statistics are that it's a very small number of fails to deliver, not small in numbers, but small as a percentage of the daily trading.
1% or so of all trades in equities fail, or 3 to 5% maybe overall in the market, although I think that's dominated by ETFs. The NSCC netting process, if the netting process sort of hiding or obfuscating the actual incidence of fails, is that a problem?
The statistics that have been shared with me are closer to that 1%, but maybe there are statistics that you'd want to point out to us and we'd learn from that. It would be really helpful. But I was just suggesting if there were specific statistics or a research paper or something, Platinum, you could send it to us, but also to meet with the staff. Our staff meets with market participants. They benefit meeting with some of the folks that are like yourself in this call.
Awesome. All right. Thank you.
All right. Thanks, Platinum. Appreciate it.
The settlement cycle spans the time between the execution of the trade and when the buyer delivers cash and the seller delivers the securities. This span of time allows, among other things, for centralized netting, which reduces settlement obligations by 98%. However, this span of time also allows prices to move, which introduces the risk that a counterparty may fail to meet its obligations. For example, if one were to buy a security and if the price were to rise, under a failure to deliver, you still have the cash, but you have missed out on a more valuable security. That is, in the interval between trade execution and settlement, each party to a trade faces the risk that the counterparty may fail to meet its obligations and any loss that may occur as a result. Clearing agencies respond to this risk by requiring the posting of margin to protect against such fails. We expect that by shortening the settlement cycle, as Matt discussed, we will reduce the risk to central counterparties because we will reduce the length of time between trade date and settlement. There is less time for prices to move in an adverse fashion, lower counterparty risk, and thus we expect reduced margin obligations. This will lower costs for market participants. The amendments solve a coordination problem. The benefits of a shortened settlement cycle require many players to act in concert. More specifically, from the perspective of any one firm, there may be operational costs with the benefits felt by others. These characteristics may make a private solution difficult, if not impossible. The Commission is also adopting Rule 15C62 pertaining to the process by which institutional trades are allocated and by which all clients agree on the terms of a trade. The final rule requires either policies or procedures or written agreements for this process. known as allocations, confirmations, and affirmations, to be done as soon as technologically practicable and no later than trade date. We believe that this will drive greater efficiency and standardization into this process, reducing risk in institutional trades. A complementary measure applicable to investment advisors should improve record keeping on allocations, confirmations, and affirmations for institutional trades. Finally, the rule contains provisions to facilitate the automation of post-trade processing between brokers and clients. So that's what Matt referred to as straight-through processing. This will reduce risk and costs and promote prompt and accurate clearing and settlement. In closing, I thank our colleagues from the Division of Trading and Markets and the Office of the General Counsel and others for their collaboration, and I thank all of you for your attention.
Thank you so much, Hashang, Matt, and Jessica. And with that, I'll turn it over to Mike.
And that was an interview. Fellas, that's where I'm going to be wrapping things up today. Let me know what you guys think about fail to delivers. I personally think that they should be all illegal. The whole idea of not delivering shares in a timely manner should make anybody doing it barred from shorting any stock ever, in my position. So before I go, I want to quickly invite you guys over to my Discord. We have a lot of content available for you guys. We have been killing it out there this week with the trade alerts that we've been putting out. It's a very active community. We have over 2,000 members in it. I am always there, so if you guys have any questions about GME, AMC, or anything you guys just want to drop in and say hi, you know, there's going to be a link and a pinned comment down below. Hope you guys have an amazing weekend. I'll see you guys next week. Peace.
Thinks that there was collusion, that the big guys, all of you guys, were figuring out how to do this and ultimately come out ahead, as you always do. But did you talk to them about restricting or doing anything to prevent people from buying, not selling, but buying in GameStop?
Let me be
anybody in your organization.
Let me be perfectly clear. Absolutely not.
So if we depose everyone in your organization, we will find that.
That is correct.
Okay, thank you.